Hi, good afternoon, everybody. Can every one of you hear me clear and loud? Okay, I presume you may be having your afternoon tea, so you can listen to my e-seminar while you're having coffee. Okay, so this is the first time we do a Q&A seminar after our main seminar last month, because we have collected more than 80 questions from the attendance to my last e-seminar. So we decided to spend another 1 hour Q&A seminar to answer all those questions. Although some questions after 1 month, the timeliness of the question may be less meaningful, but I think it is also a good timing to answer those unanswered questions, because lately, a lot of the companies listed in Hong Kong have reported their interim results. So with the interim results out, I think the prospect is clearer. The visibility has improved. Okay, so this is the risk disclaimer I need to show. Okay, let's do a China and Hong Kong market update first. In July, you can see the A-share market rallied very sharply since early July, and it reached around 3,460. And because of the sharp rally, regulators, including the CSRC in China, are concerned about the health of the stock market. So they came out, they issued their press commentary saying that the rally was too drastic. And then, so there was a correction after that sharp rally in early July. But after then, over the last half month, the Shanghai Composite Index had slowly crawled back to the 3,000 level. So this time round, we noticed the regulator did not say anything. Did not say it's too high or the rally is too drastic, because the market has corrected, consolidated for almost 1 month. So we're expecting a breakout in the near future of this resistance level around 3,460. This is the immediate resistance. And if the Shanghai Composite Index is able to break out of the 3,460 resistance, we are looking at the next target, or the next resistance level, around 3,590. And support here, also for your reference, we expect the first level of support to be around 3,310, around here, the 10-day moving average. And the next support level would be 3,260, which is around here. And then the key support, the major support level is 3,180. We expect strong support in this at this level. Okay, Hang Seng Index lags behind the Hong Kong stock, because a lot of the old economy stocks listed in Hong Kong, namely the property developers, the REITs, the utilities, and the property investment companies holding shopping malls, they underperform the new technology stocks. So Hang Seng, from a technical analysis point of view, the Hang Seng Index was stuck between the 100-day moving average and the 250-day moving average for almost more than 1 month. It was stuck between these two moving averages. In early July, it has made a failed attempt to exceed the 250-day moving average, but it failed to hold above the 250-day moving average. So now the resistance would be 25,780. That's where the 250-day moving average lies at the moment. If it manages to break out of this resistance level, the next resistance level would be 26,780. And further up would be 27,960, close to 28,000 seen in February this year. So upside target, we're looking at these three levels. As for the support level, the first support level is 25,150, which is around here, where the 50 and 20-day moving average is the near-term support. And then a bigger support level is expected around 24,610, which is where the 100-day moving average lies now, the 100-day moving average. So over the last 1 month or so, it shows resilience, it shows support, the 100-day moving average. And if it's just a if, the 100-day moving average fails to hold, then the next support level would be 23,700. It's around here. Yeah. Okay, so this is our short-term projection of the Shanghai Composite Index and the Hang Seng Index. If you ask me, we are slightly more upbeat on the A-share market because of the economy is recovering, better economic data coming out, as well as more stronger fund flow into the A-share market. But for Hong Kong, we expect the action to be in individual stocks rather than the broad index. That's why since the fourth quarter last year, I had kept recommending new economy stocks. We recommended Alibaba, Tencent, Meituan, and what else? Ping An, Good Doctor. So these stocks are outperforming the market. They fare quite well. So going forward, I would like to introduce one new vehicle for you to invest in new economy stocks in Hong Kong. That is the Hang Seng Tech Index, a technology index. It was launched in July, on the 27th of July, just 1 month ago. The base and base date, if the base date being December 31st, 2014, then the base index was 3,000 points. Now it's around 7,000 something. So it has risen more than 1/4 since 2014. Now the market cap as of July 24 of all the constituent stocks is 936 billion Hong Kong dollar. And the Bloomberg ticker is HSTECHN. Okay, so I think this is an important, an attractive investment theme going forward. Let me share with you how the constituents of the Hang Seng Tech Index are chosen. First, they are Greater China companies at Hong Kong EX main board. So all the companies are listed on the Hong Kong EX main board. They have to go through a velocity test. And then sector-wise, they come from IT, comprise IT, consumer discretionary, industrials, financials, and healthcare. As for themes, the themes cover cloud, digital, e-commerce, fintech, and internet. And then these companies have to be innovative companies. Tech-enabled business and the R&D investment must be equal or bigger than 5% of revenue. And then these companies have to record at least 10% annual growth in revenue. Actually, the threshold is quite low. And these companies must have a free float adjusted market capitalization. The index itself is based on free float. So it's a free float adjusted market capitalization weighted index. Okay, this is the sector breakdown of the Hang Seng Tech Index. Consumer discretionary accounts for 28.5% of the index. Information technology accounts for nearly 50%. So IT is very important in the index. Communication services account for 13.6%. Healthcare accounts for 8.5%, and financials surprisingly only accounts for 1.9%. Okay, so this is the sector breakdown of the constituent stocks. These are some of the index highlights. It consists of 30 Hong Kong listed tech companies, and of course there are more than 30 Hong Kong listed tech companies, so they will only choose the top 30 with the largest market capitalization to become the constituents of the index. It's very diversified because each single stock has a cap of 8%, so it will not be heavily concentrated in one or two gigantic stocks. And the screening criteria I mentioned just now, they must be tech-enabled business, and the R&D investment must be at least 5% of the revenue, and revenue annual growth must be at least 10%. And there is a quick reaction to tech sector change by introducing quarterly review of the index. They may change constituent stocks every quarter. And there is also an IPO fast entry rule to closely reflect market movements. I think this is a very big move. It will be a big catalyst to the index because it's reported that Ant Financials is going to be listed in Hong Kong. So this IPO fast entry rule will enable Ant Financials to be included as a constituent shortly after the listing. So going forward, it will include more huge tech companies. Okay, the index itself will offer lower volatility. Tech stocks have higher volatility than those traditional large cap stocks. And investing in a portfolio allows investors to enjoy a lower volatility than investing in individual stock. So you're not just investing in Alibaba or Tencent or NetEase or JD.com, but you are investing in a portfolio. So these are some comparison of the volatility. If we take single stock under the Hang Seng Tech Index, the average volatility of each single stock among the 30 constituents is quite high. If you buy individual stocks, the average volatility will be around 58.7%. This is annualized standard deviation for 260 trading days until 31st of July this year. Hang Seng Index, the single stock average volatility is lower because a lot are blue chips, a lot are old economy stocks. The average volatility is 34.1%. And for this index, now we look at the index as a whole, the 30 stock portfolio. The average volatility is 36.4%. So it's slightly higher than the Hang Seng Index individual stock average volatility, but much lower than single stock average volatility under the same index. Okay. Now, these are the top constituents as of 27 August. It will vary because of the share price, of the change in the weighting. Currently, because Meituan has risen quite a lot over the last 1-2 months, so it accounts for 9.8% of the index. Xiaomi accounts for also because of the sharp rally in price lately. Alibaba accounts for 8.7%, followed by Tencent, Sunny Optical, JD, SMIC, All Health, and King D. And last on the list, the top 10 is PA Good Doctor, which accounts for about 3.8%. Okay, if you want to invest in the index, you can't invest in the index because right now there's no future products launched yet. But last Friday, the first ETF on the Hang Seng Tech Index was listed. It was managed by CSOP, China Southern Oriental Patron, and the stock code, the ticker is 3033. Going forward, there will be more. We are expecting more Hang Seng Tech Index ETF. This Friday is reported Hang Seng fund management company will launch its Hang Seng Tech Index ETF. So we are expecting more tech index ETFs for investors to choose from. So going forward, you have a lot to choose from. The listing day of this first tech index ETF was 28th August, last Friday. Inception price was 7.5 Hong Kong dollars. And the underlying index was this Hang Seng Tech Index that I explained just now. Trading lot, 200 units. Management fee is 0.99%. Okay, so the investment amount is rather very low for the man in the street. It's very low investment threshold. If we do a comparison, if one is to buy one lot for each constituents of the 30, buy one lot of all 30 constituents, it will cost more than 460,000 Hong Kong dollars. Just one lot of every constituent stocks based on the closing price as of 31st July. If one say 30 stocks for me is too many, I will only buy the top 5. Buy one lot for each of the top 5 constituents will cost more than 110,000 Hong Kong dollars. But if one buys one lot of this ETF, just now the unit is 200. The broad lot is 200 units. So at 750, it costs about 1,800 if at 800 or so this is a little bit estimated highly. So among the 30 stocks, it is a breakdown. 21 stocks, the minimum investment for one lot. Hong Kong, there's the lot size is more than 10,000 Hong Kong dollars. So for among the 30 constituent stocks, 21 stocks, if you buy one lot, it will cost you more than 10,000 Hong Kong dollars. Two stocks will cost between 5,000 to 10,000. Only 7 stocks are the one bought lot. Buying one lot will cost less than 5,000 Hong Kong dollars. Okay, so this is 3033. You can look, but let me remind our investors here. Last Friday, there was very volatile. The share, the ETF price fluctuates. It went up to as high as 20 Hong Kong dollars, which is crazy because the NAV. When you buy ETF, you must look at the NAV, and the fund management company will provide intraday estimation of the NAV of the ETF. Last Friday, throughout the day, the NAV hovers between 750 to 770 Hong Kong dollars. Wow, but at the opening, at the so-called the AO auction auction process, the price shot up to 20 Hong Kong dollars. Because some investors are treating it as the IPO. IPO share price, can go up 2 times, 3 times on the first day, on the debut. But for ETF, it should not happen because there's an NAV. So in future, I will advise all investors, if you are interested in investing in this tech index ETF, you have to look at you have to refer to the NAV published by the fund management company and compare it with the market price. If it's trading on par or at a discount, at least if you are upbeat on the index, then you should buy. But if it's trading at a premium, worse still, a big premium as last Friday, you have to be very careful. Okay, okay, let's start the Q&A. I have consolidate some of the questions and group them under different topics or themes. So the first set of questions are focusing on the A-share market. There's one question, 怎么看 A 股最近的行情？有可能是一波大行情的开始吗？ And then because it was asked last July after the rally in early July, so an attendant asked, 这几天中国股票涨得太好，是暂时还是牛市要来呢？我现在买入好，还是等过几天回调呢？ And then another question about the reform, because Shanghai Stock Exchange is going to delist or not delist to remove those constituent stocks of the major index. Those are not underperforming or loss-making companies. They will remove those companies from the index. So how will this affect the A-share market? Which China ETF is good to invest? And is A-share China stocks listed in Hong Kong EX? Okay. So for the first two questions, I think just now in the early part of my presentation, I've already shared with you our view on the A-share market. We expect the A-share market to rise gradually or moderately after the consolidation in July and May and August. We expect a breakout of the 3,460 resistance level, and we're looking at close to 3,600. So because now there is this talk of the Asia market is developing a healthy bull market, 健康流. So this is what the regulators and the Chinese government will be happy to see, rising stock market, but at a moderate pace. So if it rises too sharply as in early July, I think investors have to be careful that regulators may try to cool down the overheating sentiment. Okay, the reform regarding the third question, I think it's positive to the index, because when loss-making companies trading at a low valuation are removed from the index, and they will add companies that make profits and trading at a high valuation, and that will push up the valuation of the index. So there will also be a positive boost to the A-share market. Which China ETF is good to invest? I would recommend 2822. This is A50, an ETF on the A50, 2822. Or another ETF on CSI 300, which is more diversified, is also a good investment target if you are upbeat on the A-share market. Okay, A-share China stocks, are they listed in Hong Kong EX? Yes and no, because they are not, literally speaking, they are not listed on the Hong Kong EX. But now foreign investors can buy A-share stocks, A-share, through under the Stock Connect scheme. That means you can trade from Singapore. If you have an account with Phillip Singapore, you can trade the A-share under this Stock Connect. Of course, not all A-shares, but only the eligible Shanghai and Shenzhen A-share, which are eligible under the Stock Connect scheme. So I hope I've answered all these questions. Questions about 茅台白酒行业看好吗？茅台都1600了，现在不止了，最新是1800了。So you can see 茅台, because of its scarcity, its share price keep going up. I think this will continue, but the entry point, I think 茅台, is it good to invest? It's beyond question. History shows that 茅台is股王,是 A 股的股王, because of its scarcity and also because of actually absence of foreign competition. In China, a lot of consumer goods are facing competition from foreign goods. But for Baijiu, China white wine, is a very unique product. So there's literally no competition, no foreign competition, only competition among local producers. But Maotai, because of its premium, and also Maotai sometimes is seen not only as a consumer good, but also as an investment. People hoard up Maotai and wait for the value to appreciate. Maotai is very, very unique. It's like Hermes in the luxury goods sector. The Birkin, Kelly, they are so scarce, and the price will keep going up. They keep hiking the price of the goods. So we were advised to wait for correction to, you look at this moving average. This is the 50-day, or you get 50 day is a bit too low. I think 20-day moving average. When the share price corrects towards the 20-day moving average, for stock with relative strength, I mean those are performing very strong performance, 20-day moving average, a retracement to the 20-day moving average is always a good entry point. Okay. How about wine stocks? There are quite a lot of wine stock 白酒股 to choose from on the Asian market. But to me, I think stick with the winner and stick with Maotai. There may be some laggards, but those laggards do not have the same uniqueness of Maotai. As I mentioned, it's more than a consumer good. It's it can is deemed as an investment. Okay, this is also a very meaningful question. 有任何板块或股票，你觉得市场存在错判 ？That means either over value or overpriced. At the moment, I think there are a few. For instance, this 海底捞 6862 is trading at 50-60 times PE, and it's just F&B stock. Of course, the recent rally is attributable to the expected recovery after the COVID pandemic, but I think it's too the rally was too rapid, too drastic, and now it's too far away from the major moving average. And then another sector I think is also overpriced, the property management sector. A lot of property management companies are being spun off from the parent company, the property developers. And because over the last few months, they are very popular on the Hong Kong market. So many of them are trading at 30 times, 40 times PE. But don't forget, property management company, they are supposed to be a very slow growth company. They, although they are very defensive, they provide property management service and earn management fees. Yet those growth, the revenue growth and the earnings growth are supposed to be very moderate. Why are they so popular or so hot in the Hong Kong market? Is because they do a lot of M&As, like the education sector. They take over other competitors. So by taking over by M&A, they will manage to grow their portfolio, their property management portfolio at a faster pace, and grow their revenue and earnings at a faster pace. But there's no warranty that they can keep doing M&A, and there may not be as many targets, M&A targets for them to acquire. So lately we noticed that selling pressure is already mounting in this sector. Okay. Based on the statistics you show, spending on IT has not increased tremendously. Does it imply that the tech stock pricing is too optimistic now? I think the attendant who raised this question has mixed up a bit about IT company, pure IT infrastructure or software company that provide the IT solution or the IT infrastructure. Actually, if you look at those outperformers, such as Tencent, Alibaba, Meituan, JD, they are not companies offering hardware, IT hardware or IT software. They're actually platform companies. They are making their profits from Tencent from online games, Alibaba from e-commerce, like and JD.com likewise. And then NetEase also make its profit from online games. Meituan is from food delivery. So it's nothing to do with IT spending. I understand in the past, the scope, the investment universe was much narrower. Investors are focusing on IT companies providing infrastructure such as HP, Legend, Lenovo, now Lenovo, Dell, or other hardware producers. But now I think the new technology stocks, they are platform companies and using IT as a delivery tool to do business. Okay. There's this question， 师傅，请问你本人认为现金价格可以投资 Tencent 或阿里巴巴吗？阿里巴巴应该买港股还是美股呢？And then 请分享关于成名纸业 and Alibaba. I think this question asks about 成名纸业 is because I think 2-3 years ago had recommended this paper manufacturer to investors in Singapore. So these are the answers. Alibaba, we still like the company because of its ecosystem. It has a very broad ecosystem that it will be able to generate revenue and earnings from. Yes, it still owns Ant Financial, and then it engages in e-commerce, and then cloud is also the largest cloud company in China. So it has just broken out this resistance level. It topped at 263 in early July, and then after one consolidation for more than 1 month, finally it broke out of 263, and now it's trading close to 300. We're expecting the share price to surpass 300, and this may happen soon because Ant Financial is reported to be listed next month in October, and Alibaba holds 33% of Ant Financial. It will benefit from the upcoming IPO of Ant Financial. Okay. Tencent is more dependent on the game sector, but in the first half this year, the pandemic, the COVID, actually it benefits from the COVID because a lot of people are homebound, so they play more, spend more time or more money on online games. So that benefit Tencent. But going forward, I think also with the possible US sanction on Tencent and TikTok, these two companies are being named by the US government. So I think Tencent will tend to underperform in the second half if we compare to other new technology, new economy stocks such as Alibaba and JD.com. It's trading in a rectangular, you can see box sideways between $500, $499, 500, and 560. So it's still stuck in sideways move between 500 and 560. If it manages to break above 560 with heavy turnover, then we do expect it can test 600 going forward. Okay, Chenming it's not bad, but it's the business itself is very cyclical. It's very cyclical. The economy it will do well in an economic expansion phase, but like first half this year, because of the trade war as well as the COVID pandemic, so its share price has dropped quite substantially. But like other paper manufacturers, the share price have rebounded quite strongly from. This is wrong chart. Sorry, but overall the performance is this. I quoted the wrong chart. But my take on the company is very cyclical. If you buy on an expansion phase, then you will get good returns. But if you buy at the wrong, the down cycle, then you may not get good returns. And okay, how do you see the recent IPO of NetEase and JD.com? Among the two companies, I favor JD.com more because of e-commerce. We like e-commerce better than online game because the online game sector are more competitive, and also there are always policies to curb teenagers or the underaged to spend too much time on online games. So there's the policy risk. For JD.com, I think although its share price, this is JD.com, its share price has risen very sharply over the last 2 weeks. Yet we still think there are still upside because there is spin-off potentials. That it was reported that they may spin off either their logistic business or their financial business. Jingdong Jinglong, Jingdong Wuliu, they'll spin off. If they spin off those companies, subsidiaries successfully, it will unlock the value of the company. Okay, so but now it's a bit too high. So one may wait for a consolidation correction towards the between the 10-day and the 20-day moving average. That would be an entry level. Okay, NetEase still not has not seen new high yet. It was still slightly lagging behind. So we expect going forward it will at least revisit the 167 historic high since it's listing in dual listing in Hong Kong. Currently is trading around below 160. We expect its share price to revisit 167, and if it manages to break above 167, the next target will be 180 or above. 小米股票还有上升机会吗? Oh, there was the question asked 1 month ago. I hope the one who asked this question has already bought Xiaomi and then now sitting on very handsome gains. Because first of all, the results are the interim result. Why it outperforms so much is attributable to the strong results in the first half, especially the internet business. Okay, so going forward for Xiaomi, now it's trading, the valuation is not cheap already, because now it's transforming itself from a hardware company making handsets and TV sets to an internet company. Now the IoT revenue from IoT, internet, finance are growing more rapidly than the handset manufacturing business. So, but going forward, it has to prove to the market that it will maintain this fast growth in internet and cloud business and IoT business. Otherwise, there will be pressure, downward pressure on the share price. And the second reason for the sharp rally is because it will be included into the Hang Seng index as a blue chip stocks, as well as the China Enterprise Index. So people are front running the inclusion of Xiaomi into which will take place in early September. So people are front running. As for Xiaomi 最近宣布回购 10% of the shares, will it have big impact on the share price? Actually, before the rally, in the first half, Xiaomi has kept buying back its shares. At that time, there was no catalyst to the share price. So buying back is not a big catalyst, I would say. Buying back would not be a big catalyst to share price. The reason for its rally recently was actually the good interim results, as well as the expectation that it will become a blue chip, Hang Seng constituent stocks very soon. Okay, SMIC. This question about SMIC. How much upside is there? Do you think SMIC now is overvalued? If not, what do you think will be the target price with consideration of IPO roadshow price? Okay, the question was asked 1 month ago. Now, the chart shows you that expectation to be listed on the STAR board, the Shanghai Technology board, has helped boost its share price to over $44. So this sharp move upwards there are two reasons accounting for the sharp rally. One is the expectation that it will be listed on a much higher valuation on the Asia market. And then the second reason is because of the US sanction on Huawei. So China will encourage its homegrown chip companies to, to be more homegrown. There are more policies to support domestic chip producers. So SMIC benefit from this policy. But the share price had a U-turn in late June, early July, between late June and early July, just on the debut of its share on the Asia market. So because it has been expected. So when this materialized, when it was listed on the Asia market, you saw the heavy sell-off. People rushed to take profits. So this teaches us a lesson. You always buy on rumor, sell on fact. Actually, this is not a rumor. There's well-known fact that it is going to be listed on the Asia market. So people start buying the shares, picking up the shares. And if you don't sell on the first day, wow, you see the share price since the debut on Asia market tumbled from 44 Hong Kong dollars to $24.10. So it dropped more than $20 from the peak. Okay, so after the drop, you see a technical rebound. Its share price rebounded from $24 to around $33. There was a technical rebound because the fall was too drastic. So there was it was oversold. The share price was oversold. So there was a technical rebound. But after hitting $33 here, it released its first half results and the guidance for the third quarter. The third quarter guidance was disappointing. So after the interim results announcement and the third quarter guidance, its share price dropped again. Now it has dropped close to $25, very close to the previous bottom. So what I expect is there will not be much big movement before October, because now all the news, the big news, we already priced in, getting listed on Shanghai Asia. It already materialized, and then technical rebound after the sharp sell-off also took place, and then the results also released. So now the market will wait for the third quarter results and the fourth quarter guidance. That may be a turning point for the share price. But that will you have to expect that in October or early November for the third quarter results. Most likely it will be October. So from now until October, I think the share price will just move sideways with very little fluctuation. But if one is upbeat about the fourth quarter, usually fourth quarter is a high season. I mean, a good quarter for IC companies. So one can actually accumulate around between around $25, and then wait for the fourth quarter guidance. If the fourth quarter guidance is better than the third quarter, so we may see another uptrend in after October, after release of the third quarter results, and the fourth quarter now is still accumulating in an accumulation phase. Okay. Weimob 可以点评微盟吗？Weimob is engaged in the SaaS business, service as a software as a service business, which is very hot in the market. The SaaS, the data as a service, infrastructure as a service. But its share price actually before the incident, I'm not sure if you are aware that they have a sabotage by a staff who had deleted a certain database of the clients. So the share price actually was on a very intact uptrend before the incident happened. So the share price came down to around $10. And then the company engaged a third party to investigate the incident, and then also to recommend preventive measures to prevent the same incidents happening in future. So its share price rebounded. But after then, the company has stated that it will set aside 150 million yuan to compensate the clients being affected by the sabotage, by the sabotage. But subsequently, because it has 3 million customers, 150 million yuan is not actually is a huge amount. But if to be divided by 3 million customers, it's calculated that each customer will only get 50 yuan. So subsequently, there were reports that some customers brought the company to court, claiming for bigger compensation. Despite this negative news report, the share price holds well around the $10 level. So we think it's already reflected, the bad news already reflected. Even there will be litigation going forward, it's already reflected in the price. And if it's able to break about $13.50, we expect another upward move to test the $15 to $16 upside. Okay. Could you share opinion on ChinaSoft? This is also a company that I recommended a few years ago. ChinaSoft is a very good company. It's engaged in IT outsourcing, and also IT solution to its customers. And many multinationals such as HSBC, Alibaba are among its major clients. The company saw, over the last 5 years, its revenue keep going up, every year new high in revenue and in earnings. But unfortunately, because of its tie with Huawei is one of its strategic investors, strategic shareholder, and the largest client of the company. So because of its close ties with Huawei, any bad news on Huawei will bring volatility to the share price. You can see between February and March, because of US sanctions on Huawei, its share price was also under pressure. But lately, after the announcement of the first half results, I think it has struck off the influence from Huawei. Now is as long as it can hold about $5, we think going forward its share price will trade between $5 and $6. This is a good company, but the bad thing is it's too close to Huawei, and now Huawei is has fallen a victim between the under the China and US friction between China and US. Okay. How is ZTE? You can see that the share price actually very weak and underperformed. ZTE is actually a competitor to Huawei, but in terms of profitability, is not as profitable as Huawei, and it's also a victim of the US sanction. And worse still, India is one of the major markets for ZTE. Now with the row between China and India, ZTE will also suffer and got hit. So we expect the company to, its share price to continue to underperform, and we don't recommend buy for this company. Can you share some technology-related stocks beside those big names, such as Alibaba, JD, Tencent, and Meituan, as well as ETF to invest? Now, a month ago, there may not be a clear answer, but now there is the clear answer. That is the Seng Tech Index ETF. Not necessarily the one I talk about, the CSOP. Going forward in future, we are expecting more issues of tech index ETF. So you can choose. You may ask, what are the parameters or the criteria to choose which ETF to choose? So in choosing ETF, we look at the tracking difference, the tracking error. The smaller, the better. The expense ratio, the lower, the better. And then the liquidity and the spread, the bid-ask price, the spread in the bid-ask price. Because if the spread is too wide, it may lower your investment return. So these are the major parameters or criteria we refer to when picking ETFs. Okay. 为什么有那么多中国公司在香港证券交易所上市？我如何参与他们的 IPO？ 下半年的 IPO 的股票会是怎么样的表现？请问在新加坡有什么方法参与港股的 IPO？ Related question, can buy Hong Kong EX, and also another question about 388 Hong Kong EX still have upside. Okay, I think because A-share, a lot of Chinese company, if they are planning a listing, naturally A-share is their, they want to list on the A-share because of higher valuation and better liquidity there. But the process for approval, the approval process is much longer. At a time, it took 2 to 3 years to process and approve an IPO. So a lot of the Chinese companies come to Hong Kong Normally, if they apply to be listed in Hong Kong, it will take only 6 to 9 months. Of course, Singapore is faster compared to Hong Kong. Hong Kong is around 6 to 9 months. So it's a faster avenue for Chinese companies to get listed. And secondly, now we're expecting more Chinese companies who are already listed in the US market to come to apply for a dual listing, a second listing in Hong Kong, because of the friction between China and the US. So I think to play safe, or as to buy insurance, they apply for a second listing on the Hong Kong EX. What will be the outlook of the IPO market in the second half? We are very upbeat because I mentioned just now, Ant Financial will be listed in October, and lately we just have a very big one. This Longfu Spring, selling mineral water, Longfu Sanchuan, Longfu Spring. And then Yum Brands China has also submitted an application to get listed in Hong Kong. So in the second half, we're expecting very mega IPOs. Ant Financial is reported to be worth, let me see, they plan to raise 30 billion US dollar. Ant Financial is reported to be aiming to raise 30 billion US dollars. If they are successful in raising this amount of money, they will become the largest IPO in the world, overtaking this Saudi, the oil company from Saudi Arabia. OK， 请问在新加坡有什么方法参与港股 IPO？ You may ask our remisiers, your remisier or your dealer with PhillipCapital to see how to participate in Hong Kong IPO. If I understand correctly, if the prospectus of those IPO do not limit or restrict Singaporeans to apply for the IPO, then you can also apply through PhillipCapital for the IPO. Or you can also participate in our gray market. There's the Phillip Mart trading before the official listing. Normally, we will open the gray market trading one day before the official listing. So these are two ways to participate in the Hong Kong IPO. So who will be the major beneficiary with more and more mega IPOs coming to Hong Kong? Certainly Hong Kong EX will benefit. And then earlier, MSCI has terminated their business collaboration with HKEX. So they are going to move their MSCI futures derivative products to Hong Kong. And this will also benefit Hong Kong EX with more products, more derivative products to trade, as well as more mega IPOs and also more Chinese companies listed on the US market applying for a second listing in Hong Kong. So 388 still have upside, yes. But now if you consider buying now, I think it's a little bit too late because the share price has risen from 250 to close to 400 just in 3 months time, from May to August. We are looking at a target of around 410 to 420. So now at 39 something, the upside seems not very attractive. But for those who are already holding, who have already bought Hong Kong EX, we do advise you to hold on until reaching our target between 410 and 420. OK，对内地银行股的看法，我们 how we view mainland banking stocks，除了中资银行股，香港的银行股有什么看法？银行股现在相当低，长期行情如何 ？What's your view on banks like ICBC and Postal Saving Bank China? Are bank shares good to buy, such as HSBC? I hold all economy shares like ICBC. Does it make sense to switch to ZA Online and China Literature? China Literature 粤文有没有牵涉到一些官司或诉讼吗？Any litigation? Whether China Literature is involved in any litigation? Okay. If you look at the chart of ICBC, wow, which is very disappointing. So its share price is still on a downtrend. I am personally, I'm downbeat on both mainland banking stocks as well as Hong Kong banking stocks. Because at a low interest rate regime, the interest margin, net interest margin will continue to narrow for banks. And in the first half this year, you can see the 4 state-owned banks, ICBC, CBC, Construction Bank of China, China Bank of China, Bank of China, and China Agricultural Bank of China, their first half earnings all dropped more than 10%. Partly because of the slowdown in the economy, so slower revenue growth, as well as a more significant jump in the provision for bad debts. So the NPL rise again, the non-performing loans. We don't expect any substantial improvement in the second half. So banking stock will continue to underperform. But if from a dividend collection perspective, now most Chinese state-owned banks are yielding more than 5%. If you don't mind the share price underperforming, that means market rising or the new economy stocks are rising and breaking new highs, yet the banking stocks are just remain at a very low level. If you don't mind that, if you are eyeing on the 5% dividend yield and very little capital appreciation on the share price, I think it's okay to buy. But if you want both, best of both worlds, if you are looking for dividend yield as well as capital appreciation, then banking stock may not be the good choice. As for Hong Kong stocks, I think more or less we are facing those challenges. Low interest rate regime, slowing economy. As for HSBC, I think the operating environment is even worse for HSBC because it's stuck between the political tension between China and US had also impacted HSBC. So we don't recommend banking stocks. China Literature, actually it did quite well between June and July, but recently its share price was sold down because of disappointing first half interim results. But I think that can be is understandable because the company is transforming from its business model from a paid model to a free model. So now it's undergoing the transformational the pains in transforming the business model. And lately there are complaints, not really litigation, but complaints from its writers about the contract, previous contract. Because in the past it implemented this paid model. So the writers are more sure to get a sharing of the subscription fees from the readers. But now they are shifting to a free model. So those writers, and under the new contract, the writers do not have choice. They cannot object to their works, their literary works, to be read free of charge. They cannot. So writers, those writers complain. But the company is looking at other earnings avenue, such as IP development or authorizing the IP of the literary work of the novel to be produced into TV series or movies, and then they will generate revenue and earnings for the company. By then, the writers can share the revenue and the earnings. But some writers are not happy with this arrangement, so they complain about this. The CEO of the company has stated that they have tried to sort it out with the writers. So lately, there are no more news about the complaints from the writers. So I think this somehow this is over. And the share price, you can see, holds well on the 100-day moving average, the green line. So as long as it can hold about $45, I think it has survived the bad news. Okay, 请问众安在线是在哪里上市？ ZA online. My previous target price was 48. Now the share price has already exceeded 48. So what is actually 众安在线 is only listed in Hong Kong, only in Hong Kong. Its share price being a new economy stocks, because its share price went up to $90 on its debut, after its debut. But then it fell from $90 to 20 to below $20. Now it's trading around 47, 48. We do expect, now it has reached my first target price of $48. I would set my second target price at $59.50 because its listing, its IPO price was $59.70. So up till now, it's still trading below its listing price, its IPO price in 2017. Among the new economy stocks, actually is a big laggard. Other new economy stocks are already seeing new highs, but Zhong'an ZA online is still below the IPO price. Its first half results were quite encouraging. The profits bigger, higher than expected. That's why its share price saw a sharp rally after the result announcement, because it ran up to $58 a bit too fast. So now we expect some consolidation around $45. And I'm still upbeat that share price will revisit the IPO price. That's $59.70. Ping An, why is it so weak? Still good. Share price has dropped more than 20% from its peak. What's the outlook of Ping An? COVID and flooding issue in China, will it affect the insurance industry? How bad is the flooding problem in China? And how will it impact the stock market? Okay, I think banks and insurance company, normally they don't do well in a low interest rate regime. And also because of the pandemic and the flooding problem, the claims rate is higher. So it affects the financial results of insurance company. And we do expect this to persist, at least in the second half. China is also keeping interest rate as low as it can, although not to the extent of a zero interest rate. Still is very low, so it's not favorable to insurance company. We would recommend avoid for the time being, Ping An, for the time being, we will recommend avoid. But for the A-share market, I don't think this flooding problem, the flooding issue has a big impact. The Shanghai Composite Index is, now is already trading at 3,400. So the index level shows that the flooding problem in China actually does not have a big significant impact on the stock market. It may have on certain individual stocks. So Ping An, you can see, is share price is quite identical to the Hang Seng Index, stuck between the 250-day moving average. That's around $86, $88, but support around the 100-day moving average. That's around $81. So we expect its share price to move sideways between 81 and 88. China Life 怎么看中国人寿 China Life used to underperform Ping An, but this year we saw something different. China Life outperformed Ping An. But if you ask me, is it because its financial results are much better than Ping An? I think the answer is no. But I think one of the reasons is because it holds 2%, around 2% stake in Ant Financial. So people are expecting the upcoming listing of Ant Financial will also benefit China Life. So its share price managed to rise above the 200-day moving average, and up till now it managed to hold above the 250-day moving average, which is around $18. Resistance is expected between $20.50 to $21. So it is expected to move between sideways between 18 and 21. Okay, what's my view on Haitong Securities 6837? Actually, if you look at this chart, security brokerage firms, brokerage stock should follow the broad market, but you can see that this divergence. In early July, the Shanghai index, just now I explained, saw a sharp rally from below 3,000 to 3,400. At that point of time, the share price of Haitong also followed the index, rising from $6 to above $9. So that rally was very, very drastic. But then after together with the correction of the A-share market, the share price also corrected from above $9 to $7. Now, what is disappointing is now the Shanghai Composite Index was already back to 3,400, back to the level seen in early July. Yet for Haitong and many other brokerage stocks, brokerage stocks, their share price underperformed the Shanghai Composite Index. Why is it so? I think the rally was too a bit overshooting, so people realize that now they are not willing to pay the same kind of valuation as in early July. So this is always the problem with broking stocks, broking firm stocks of broking firms. They may not follow the index. So might as well, if you for more certainty, one may be more conservative and just invest in the index ETF. Because if index goes up, you buy the ETF, you sure you make money. But if you bet on the brokerage stocks, this is the example that index goes up, yet the share price of brokerage stocks do not go up. Okay, I recommended this 石药集团 so 可以买吗? Yes, we think there's still upside because its share price has consolidated between $15 to $17, $16.50. So now recently, after the announcement of the first half result, it's broken out, seen a breakout of the resistance, and it will be. It has planned. It has announced that it will list on the China, the Star Board, the A-share market, 科创板. So this, I think, has not been fully reflected in the share price. We are looking at $19, a target of $19. So around $17 if you buy at $17 and setting the target at 19, at least you have a $2 return. Okay. Cheong Kong, Hutchison, what's the outlook? The outlook is I'm quite downbeat on Cheong Kong Hutchison because a lot of the business are very cyclical. The energy business, the port business, as well as the telco business in Europe. So it's also a lot of business are in Europe and the UK. So this pandemic also deal a blow to the overseas operations. So it will continue to underperform Cheong Kong and Hutchison. 禹州集团, this is a property developer, but not the big ones lah. It's a medium-sized property developer. So actually, you see the share price just move sideways. To choose property developers, I will favor the big ones because property development is capital intensive. The big ones, they have they will have enjoy the economy of scale, as well as a big land bank and a relatively lower replenishment cost, and also faster return of the capital return from the sales of property. At the moment, I think it's capped by the 250-day moving average, which is around $24. Upside, maybe if they manage to break about the 250-day moving average, one can look at 27 to 28, and support is expected at $21. Okay, can we still consider Beijing Enterprise Water for investment and China Everbright International? What's the investment potential? These two stocks have dropped quite a lot because, first of all, environmental protection is not in the favor of the market at the moment. And I think both companies actually are good companies, and they have signed up a lot of new projects. But the problem is the BOT business model is unfavored by the market at the moment. Because by BOT, it means build, operate, transfer. So they have to invest and build whatever projects, the energy to waste power plants or the water treatment factories. So they have to invest a lot, and then they are expected to recoup their investment and their profits within the franchise operating period, maybe 25 to 30 years. So the debt level of these companies are normally quite high, and then the finance expenses are also quite high that eat into a lot of the profits. And for China Everbright International, they have done a rights issue, I think 2 years ago, but because they have signed up a lot of new projects, so they have become a victim of its own success, because more new projects means more fundraising needs. So market are fearful that they may have to raise money by either rights issue or share placement, so that pressurize the share price. So at the moment, I think PE is low. The valuation of both companies are very low, and the dividend yield honestly speaking, the dividend yield is not very attractive because the company itself is highly geared. So they are not able to pay very high dividend yield. So what I can say is these companies are still in the investment phase. They have to invest, keep investing, and then the recouping, the time to recoup the investment as well as the profits will be very, very long. So they have not reached the harvest stage yet. So at the moment, I think, but at this level, I think if those already bought the company, you can just hold on. Regarding the question whether why they are not converting the assets to trust REITs to reduce their borrowing. REIT, I think Hong Kong, they are more, investors are more used to having REITs from property, commercial property, rental income from commercial property. So it's not common to see these environmental protection companies converting their assets to REITs. And for REITs, the attractiveness is they will pay high dividend, more than 90% of their income to the holders of the REITs. But for Beijing Enterprise Water and China Everbright International, because they are in the investment phase, so the retained earnings are actually after they have to repay the debts. So the ability to pay dividend is still not as high as those property investment company. That's why I don't think they are considering spinning off the assets into a REIT. Okay. 金界控股可以买吗 ？Nugget Corp. Okay. It's also impacted by the COVID pandemic, but we do think the pandemic will be over one day, and with the vaccine coming out, I think one can expect a recovery in the business as well as the share price. The share price has dropped from about $14 to 7 something. So we have half, the share price have half. Recently, there were news that China is going to issue a so-called blacklist. I'm not sure if you heard about it, because it states that a lot of the neighboring countries, such as Vietnam, Cambodia, Australia, they are luring Chinese tourists to their casino. So this is something the Chinese government not happy with. So they're going to issue blacklists of countries that offer gaming service or gambling to their citizens. But personally, I think this may be targeting more at Australia, which is at odds with China at the moment, rather than Cambodia or Vietnam. Especially Cambodia is on good terms with the Chinese government. So after the share price got a hit last Thursday because of the report of this blacklist on travelers leaving the country. But subsequently, you can see share price rebounded very strongly from the sell-off. So I think at this price level, still there is upside. One can take the opportunity to buy Nugget Corp. Okay, COFCO Meat. This is a state-owned company producing pork and pork processed. It is engaged in pork farming as well as processing. So it's very vertically integrated. The first half results was very impressive. It benefits from the rising pork prices in China. And because of this pandemic, pork prices are expected to remain at a high level in the second half. So the recent sell-off is just a correction of the sharp rally in the last 2 months before the earnings, the interim results. We do expect support between 340 and 350. If one is upbeat on the cycle of the pork industry in China, pork processing industry, I think between 340 and 350 is a good entry point. Okay, and the share price, we are looking at the upside of 410 to 420. Okay, this is the last question on education, on an education company called Maple Leaf Education, 枫叶教育. This is actually, in fact, the first education company being listed in Hong Kong. So at that point of time, because there were no other choices, and people are upbeat about the education sector in China, because now the middle class is emerging. More middle class parents are willing to send their children to high quality schools for better education, or even sending their students, their children overseas to study. So this creates tremendous demand for education companies. But its share price have a bit overshot, so it went up to more than $7. And because of disappointing results, as well as more education companies are being listed, so there are more choices. Investors are 贪心忘旧, they go for the new one, forgetting the old one. So Maple Leaf Education was actually sold down for almost one year. Now it's gradually recovering, but we do expect a lot of selling pressure, because a lot of people are trapped between $3.50 and $4, and some are even those who bought above $6-7. So there will be a lot of resistance along the way to rebound. Short-term resistance is expected to be 350 to around 350. Above 350, the next resistance level will be $4. Okay, so I've answered about 80 questions raised. So since this is a long Q&A session, we don't entertain any more question from the attendants, but I just hope I can reply those questions being asked in my last seminar, and also give a more updated view on the Hong Kong and China market in the next 2 or 3 months. We are expecting, I think, another seminar in October. That will be the quarterly one. Last one was done in July. This is a follow-up seminar on the Q&A. Hopefully, if there are a lot of questions received in my next seminar, we will also do a follow-up and a Q&A seminar to answer those questions in the following months. Let us have your feedback of our arrangement. If you feel this is good, let us know, and then we'll keep doing it. Thank you. Thank you for your time.